How in the world is it that two massive, undeniably world-dominating tech companies achieved their staggering success by starting from completely opposite ends of the financial universe? I mean, on one hand, you have Facebook, right? They went the classic, traditional route, securing millions upon millions from heavy-hitting institutional investors. But then, on the other hand, you have Oculus VR. This is a company that literally went to the internet and asked the public for spare change to build a virtual reality headset. Both of them totally conquered their respective markets. Both ended up as multi-billion-dollar titans. But their starting lines, they literally couldn't have been more different. So today, we are going to solve that mystery. Okay, let's dive into this. Welcome to this comprehensive course-style explainer where we're going to decode the high-stakes world of business finance. Look, whether you're an aspiring entrepreneur with the next big idea, or you're just a focused learner who loves understanding the nuts and bolts of how the business world actually works, you've got to understand where the money comes from. It is absolutely crucial. We're going to break down the strict mechanics of traditional funding and put them right up against the wild, rapidly evolving frontier of alternative funding. So here is our quick roadmap for today's explainer. We'll kick things off with funding your big idea, explore the traditional funding path, then pivot over to the alternative funding path, compare the two paths head-to-head, and finally wrap up by helping you choose your strategy. All right, getting right into it with Section 1, funding your big idea. Because at the end of the day, every massive business needs capital to actually get off the launch pad. Moving straight into Section 2, the traditional funding path. Let's start by defining venture capital, or VC for short. Basically, these are investment funds that manage pooled money from investors to inject capital specifically into startups with really high growth potential. Now, what you absolutely need to understand here is that VCs aren't just nicely handing out loans. Not at all. They are providing equity-based funding. They hand you a massive check, and in return, they take a percentage of ownership in your company. It's a trade. They focus heavily on high-growth sectors, and because it's their money on the line, they demand a serious seat at the table when it comes to your management decisions. Let's weigh the realities of venture capital. The pros are incredibly powerful, for sure. You get access to massive amounts of capital that can scale your business basically overnight. You also get strategic support, mentorship, and an instantly enhanced network and credibility. It's a huge stamp of approval. But we gotta look at the cons. That immense capital comes at a really heavy cost. You face significant equity dilution, which means you own much less of your own baby. You're also immediately thrown into a pressure cooker with high expectations for exponential growth and immense pressure for quick, massive financial returns. It is a high-stress environment, so, say goodbye to your weekends. To really put that into perspective, just look at this number, $12.7 million. Back in 2005, a venture capital firm called Excel Partners invested this exact amount into a relatively young, kind of niche social network called Facebook. This single VC move was the rocket fuel Facebook needed to rapidly expand its user base and build out its platform. It scaled them into the globally dominant player we know today, ultimately leading to that massive IPO in 2012. But hey, venture capital isn't the only traditional route in town. Let's shift gears and talk about angel investors. An angel investor is a wealthy individual who provides capital to startups, usually exchanging it for equity or convertible debt. Now, unlike VCs, who manage pooled money from big institutions, angels are actually investing their own personal cash. Because of that, they typically get involved much earlier in a company's life cycle. This is great because it means they often offer much more flexible investment terms, plus highly personal involvement and mentorship to really guide founders through those super fragile early days. If you want to see just how impactful an angel investor can be, consider this. In 2004, Elon Musk stepped in as an angel investor, injecting $6.5 million of his own personal wealth into Tesla's Series A funding round. This early, super-critical influx of cash is literally what enabled Tesla to develop their very first electric vehicle, the Roadster, and actually bring it to market. That initial angel investment planted the seed for a company that would eventually shatter all expectations and hit an astonishing valuation of over $800 billion. Crazy, right? All right, let's completely flip the script. Section 3, the alternative funding path. Leading the charge in this new wave is crowdfunding. This is all about raising small amounts of money from a massive number of people, typically using online platforms. Now, what's really fascinating here is how it fundamentally flips the traditional investing script entirely upside down. Instead of trying to convince one billionaire in a stuffy boardroom to give you $1 million, you are convincing 1 million regular people on the internet to give you $1 each. It turns the general public into your own massive, incredibly diverse investor base. So let's break down the realities of crowdfunding. The pros are absolutely fantastic. You get access to this wildly diverse base of backers, and the campaign itself acts as incredible marketing. Like if people actually fund it, your idea is instantly validated by the market. Boom. Plus, you have flexible options, like offering cool product rewards rather than giving away your precious equity. But we've got to be real about the cons here. Managing these campaigns is incredibly time-consuming. And honestly, the scariest part, you are forced to publicly disclose your intellectual property and business ideas to the whole world before they're even fully built. Plus, there's always the very public, very awkward potential for your campaign to just fail. But man, when it works spectacularly. $2.4 million. In 2012, a little company called Oculus VR launched a Kickstarter campaign aiming for what they thought was a modest $250,000 to build a virtual reality headset. They didn't just meet that goal, they absolutely smashed it, pulling in $2.4 million. This didn't just give them cash, it proved undeniable, screaming market demand. And the irony here? This huge alternative crowdfunding success is exactly what attracted the ultimate traditional giant, Facebook, who eventually swooped in and acquired Oculus for a cool $2 billion. Now let's pause for a second because the alternative path gets even more complex and a bit wilder, with initial coin offerings or ICOs. This is a totally different beast. It's a form of crowdfunding using cryptocurrencies, where companies issue digital tokens in exchange for investment. So it's entirely blockchain-based. The massive advantage here? Well, actually there are two. Incredibly fast fundraising with access to a global pool of investors, and absolutely zero equity dilution. You keep all your ownership. However, it carries extreme risks. You're dealing with high regulatory uncertainty, a very real risk of fraud, and wild market volatility. It is the literal definition of a high-risk, high-reward Wild West. Time for the ultimate showdown. Section 4, comparing the two paths. So how do they actually stack up? When we look at eligibility, traditional funding, like your standard bank loans, requires strong credit, hard collateral, and a proven business model. Alternative funding is just far more accessible right out of the gate with way less stringent criteria. Regarding speed, traditional routes involve lengthy, sometimes painful application processes. Alternative online platforms, they can move at lightning speed. Finally, let's talk risk. Traditional methods are generally lower risk for the investors because they're secured by collateral. Alternative markets, which totally lack that collateral and are subject to huge volatility, present a much higher risk for the folks actually putting up the money. But here's what it all really boils down to: control. This is the ultimate battleground for any founder. With traditional funding, those bank loans hang over your head with strict repayment schedules. Venture capital and angel investments force you to dilute your ownership, meaning you are literally giving away pieces of your company and, ultimately, your control over its destiny. Versus alternative funding, where models like rewards-based crowdfunding or revenue-based financing offer non-equity options. This uniquely allows the founder to preserve their ownership and steer the ship exactly how they see fit. Which brings us to the final and most important step. Section 5, choosing your strategy. Let's get practical and walk through a strategic framework derived straight from our source material together. Step 1, choose a hypothetical business idea, or hey, use your real one if you're working on it. Step 2, ruthlessly evaluate the suitability of traditional versus alternative sources based on everything we've just uncovered. Ask yourself, do you have collateral? Do you desperately need an industry mentor? Can you survive giving up 20% of your equity? Step 3, create a concrete strategy outlining your chosen sources and your precise justification for them. By actually doing this exercise, we bridge that crucial gap between business theory and real-world execution. I want to leave you with this final, kind of provocative thought to chew on. If you were launching your absolute dream startup today, right this second, would you sacrifice a piece of your hard-earned equity to gain the massive capital and established expertise of traditional investors? Or would you brave the wild volatility and risk of the crowd to maintain absolute total control over your vision? Listen, there's no objectively right answer here, only the answer that is right for your specific business. Thank you so much for joining me in this explainer. Keep analyzing, keep learning, and I'll see you next time as we dive into another fascinating topic.